How's it going, friends and family? Between you and me, it's really tough being a value investor right now because every week, well, leading up to this week, seems like every other AI related stock is exploding in valuation, reaching all time highs when we talk about Micron, SanDisk, and then most recently, the IPO from South Korea, SK Hynix, they're going up and up. While our value investing portfolio and our holdings barely move. Dare I even say, for some high quality names like Microsoft or Meta or even Walmart, you might be in the red. This also includes MasterCard, well, Visa, 1% for the past 7 months. I guess that's not a good CAGR. Needless to say, some of the high quality blue chip household names not doing much. And if you're honest with yourself, if you're sitting on the toilet, you might have asked yourself the question, is value investing dead? And if you're feeling that FOMO, that fear of missing out, like, man, should I jump on the SSD and RAM hype train? I guess the ETF DRAM really depicts what I'm talking about. It has every single one of the AI related names that are just exploding. Seagate, Western Digital, SanDisk, Micron. Although, to be quite frank, when the market closed on Friday, negative 8.7%. That's pretty bad. But again, if we zoom out and take a look at it from a bird's eye view, 97% year to date for 7 months, that's pretty darn good. So you might be feeling FOMO, and I'm here to say that you're not alone. Even I experience it, okay? Watching everyone else get rich while your portfolio barely moves, it's frustrating. It's like, I'm happy for them. Well, it depends on who you are. You might be jealous and say, I wish nothing but the worst for them. Depending on who you are, deep down inside, you can't help but feel like, why can't it be me? When is it going to be my turn? Friends and family, when you decide to flip-flop and radically change your style and your philosophy by giving in to the temptation of chasing the momentum and the hype and the meme stocks, that's exactly when most investors get burned and they make very expensive mistakes. For some of you who invested through 2020, 2021, you know exactly what I'm talking about with the meme stocks and the frenzy. A lot of people made money, but on the other side of that spectrum, a lot of people lost money as well through the IPOs and the SPACs. And a lot of these companies that were operating with smoke and mirrors did not even generate a single dime of profits. A lot of the EV manufacturers and some other speculative industries. But if we zoom out and take a look at it from a history textbook perspective, Peter Lynch, probably one of the greatest investors of all time, he ran the Magellan Fund over at Fidelity, and he had market-beating returns year after year for quite a while until he tapped out and said, I'm done, I'm retired. He wrote about this in his book, One Up on Wall Street. And in that book, it basically summarizes how you and I, as the average investor, we have a leg up on Wall Street because those dudes are in suit and tie in New York City, Chicago, Boston, looking at stuff, the data and the financials from their office. Whereas you and I are boots on the ground. We have hands-on experience. We are the working people that can see evidence from our own eyes, the tangible proof that a business is thriving. Or we might have anecdotal evidence that a certain industry or sector is about to boom because of your profession or career. Wall Street, they don't know that. So he advocates that the average person should be investing because we have a leg up on Wall Street because we are the ones that are living in society, contributing to said society. But anyways, in that book, by the way, if you haven't already, you should read it. He argued that the hardest part of investing is not finding the next 10 bagger or finding great companies, but rather the hardest part of investing is having the patience to hold on to a really good compounder while everyone else abandons them to chase the next hot stock. And I also think he's attributed to the quote, the most necessary organ in order to invest in stocks and to be successful is not the brain, but rather the stomach. Like, can you stomach the volatility of when stocks go 10% in the green, but also 5% in the red the following day? If you can't handle that, probably better off in an index fund like VTI, VU, or SPY, because then you're diversified and you have exposure to everything, but that's neither here or there. So the reason why I say that is history shows us the moment value investing feels broken or that value investing no longer works, that's often the exact moment that investors are rewarded for sticking to their process. Maybe not today, maybe not tomorrow, but a year from now, 2 years from now, once the supply chain constraints and the bottleneck of SSD and memory clears up and that comes tumbling down, value investing will be back on top. I mean, what you see on your screen right now is SPY, represents the S&P 500, the 500 largest blue chip household names here in the US. Maximum timeline from 1993 until now, 1,500% into the green. However, I want to turn your attention to 1997, 1998, 1999. During that era, if you're young, listen up, I'm going to sound crazy, but we used to have dial-up internet, meaning we had to sacrifice the ability to use a landline phone, use that cord to plug it into something like AOL to get internet service. And internet-related companies and businesses, all the rage. So because of the age of the internet, in 1996, SPY, roughly $67, as we started learning about the revolutionary prospects and outcomes because of the internet, SPY went to $146. So practical terms, it 2x'd. And the age of the internet, momentum stocks became so infectious and contagious that everyone wanted a part of it. I would even say that if you were not buying speculative internet stocks back then that had zero profitability, negative free cash flow, people were laughing at you because they're like, dude, you're not buying into it right now for what they're able to do, but rather in 10 years from now. So yes, I'm putting my entire life savings into a company that is negative net income, that has zero cash on the balance sheet, that has $10 billion of loans. That's exactly what I'm doing. And you're not, dude, you're so stupid. In hindsight, it's 2020. But back then, in 1988 and in 1999, there's a lot of examples of really wealthy individuals calling their financial advisors and their stock brokerage account to transfer all of their cash from value-oriented stocks into hype to chase the momentum. A lot of them did that. But when the dot-com bubble crash happened and it went from $145 down to freaking $84 in 2002, a lot of those individuals lost a good portion of their fortune. And to this day, in 2026, people who lived through that experience, they still don't go near stocks because they watched their net worth go from $3 million down to 20 grand because they invested in stocks. But one could even say they weren't even investing. At that point, they were in a casino pulling that slot lever and they were gambling. They were chasing hype. They knew exactly what high risk, high reward means. Some people think high risk, high reward means, oh, it's always going to go up. But high risk also means that you can lose everything. And in that case, that's what happened. While at the same time, when it went from $145 down to $84 and the tech stocks that were not profitable disappeared, value-oriented stocks, dude, they were booming. They were cruising. They were business as usual. And so the investors who stayed patient with value stocks, they were the winners in the end. Obviously, in 1998 to 1999, leading up to 2000, they looked stupid. Like, oh, have fun with your measly 10 to 12% gains in a single calendar year while we're out here on a rocket ship. Ha ha ha. Who got the last laugh, right? So even though a lot of the tech-related speculative stocks disappeared, there's one company, Cisco, ticker symbol CSCO, who was probably the hottest stock on the block in the year 1989. If you had bought them during that whole situation, look at this crazy run-up. And that's exactly what I'm seeing with Micron, Seagate, SanDisk. Very cyclical, the semiconductor chip stocks. Right now, if you're new to the stock market, you're probably thinking that it's going to happen forever, till the end of time. But cyclical stocks come and go in waves. You buy enough in order to ramp up production and build out whatever you are, and then you take a step back, you pump the brakes, and then it's reflected in their P&L. Their 20, 30, 50% gains across all the numbers and ratios start tumbling down, and that's when their stock price gets demolished. But anyways, so Cisco, 1997, about $5, running up to the dot-com bubble crash. Look at this, went to 50, and then at its peak, about $79. So for somebody who bought Cisco in the year 2000 to get to $79 again, because you bought into the hype, FOMO, and you chased momentum, it would have taken that individual 25 years to break even. 25 freaking years. And when you bake in opportunity costs, that same dollar, that 79, like accounting for inflation, you would have lost a crap ton of money by just buying and holding a company that you bought at the top. That's why for me, sometimes if I realize it's going to take way too much time for me to break even or to see a red position go back in the green, I just cut my losses and I redeploy that capital into something else. But that's neither here or there. The reason why I'm pointing out the Cisco situation is because if you take a look at Micron, I mean, their entire timeline, they were basically pretty much flat going into 2022. I guess we could do 5 years, still roughly like $50 a share. And then look at what happened, right? I'm not trying to insinuate that what we're experiencing is the exact same thing as the dot-com bubble crash, because back then it was all speculation, hype, and mirrors. Whereas right now, the memory and SSD stocks, they basically are able to charge whatever they want because there's only so much memory chips to go around. So the data center hyperscalers are paying crazy amounts of dollars to get SSD and RAM into their data centers. And that's why they're crushing it, right? $90 billion of revenue. If you take a look at their net income, $50 billion of profits going into their pockets. So unlike the dot-com bubble crash, right now we are seeing tangible evidence that they are generating and printing cash. Huge difference. But I do feel for the individual that did buy at the top at about $1,255 a share. Because Micron is now currently $920. For all case and purposes, they could be $1,500 by the end of the year. Or, just like the dot-com bubble crash, that might have been the peak. And now Micron's going to crash right back down to $450, back to $100, back to $60 a share, which is more in line with their historical stock price based on their numbers and fundamentals. And that's why me personally, I just don't have the risk profile and the risk tolerance to jump in to Micron or to buy the dip on Sandisk. I just can't do it because I don't think I could forgive myself if I jump in at $920 a share while it continues to fall further to $400 or even $100. I would be very upset with myself because it wouldn't be predicated upon fundamentals and value investing, calculating that it's the right price for a really high quality compounder where their revenue situation does not have ebbs and flows, but rather it's slow and steady up and to the right. But rather it would be based on emotions, saying, I need to jump in now. 9 out of 10 times in life, when you allow emotions to steer the ship, especially as a man, not a good outcome. Usually not good consequences. So thinking about it rationally and objectively, I just know I don't want to do it. I can't pull the trigger. I mean, to be quite frank with you, out of the entire memory SSD landscape, my winner, if I had to do it, would be SK Hynix, because as a South Korean operation, companies that choose to do business with them, they don't have to be faced with tariffs, trade wars, or any crazy implications. And not only that, based on my understanding, SK Hynix, HBM, world-class, market leaders. And so if you want the best, you go with SK Hynix. Not to say that Micron and SD are trash or terrible, it's just not as good. A good comparison and example would be like a Toyota versus a Honda. Like a Honda is a very good car as well, but a Toyota is a lot more reliable. Or in stock examples, NVIDIA is the same thing as SK Hynix, whereas like AMD could be Micron. They serve a different purpose in the same space. It's different, but there's a clear winner. But I want to clear this up before we go any further, because the mistake that most people make today, if you identify as a value investor, is defining value by only looking at the price to earnings ratio, otherwise known as the PE ratio. So what you see on your screen right now is Stellantis, ticker symbol STLA. Their forward PE ratio based on next year's EPS is a 5.9. And for some value investors, they might look at this and be like, dude, what an opportunity, what a steal, what a bargain. I would pump their brakes. And by the way, Stellantis, it's the parent company of Jeep cars, Ram trucks, Dodge, Chrysler, and some other Italian and French brands. And this stock has been struggling because if you lift up the engine hood and take a look at the numbers and the financials, it's shaky, it is rocky, it is inconsistent. It is the exact opposite of what you want to see in a dividend compounder with cheese, which is smooth and steady, reliable, sleep well at night. Stellantis, you don't know what you're going to get. Sometimes it's up, sometimes it's down. That's why the stock price is also the same thing. Sometimes it's up, sometimes it's down. Negative 70% in 5 years. And I bring this up as an example because sometimes a company has a really low PE ratio because it's an ugly business with an even grosser future. That's why their PE ratio is low. It's low for a reason. It's not low because it's an undervalued hidden gem, because it's flying under their radar. It's cheap in a valuation lens because it's a bad business. I would not invest in Stellantis. Like if I had to invest in a car company, it's tough because I wouldn't want to, but I'd probably go with Ford or GM. And not because I like American-made cars, because I think even though I'm very bullish on the American economy and American businesses, me personally, I drive Asian cars. I just do not like the reliability of an American car. But because of the contracts with government agencies, police departments, and their future role in the defense contractor industry, I would feel a little bit more bullish towards them than I would with Stellantis. So don't get me wrong, when I say value, I mean a high quality compounder that has a reliable cash flow and a stable dividend profile that just so happens to be mispriced by the market. Case in point, I'm not invested in them, but Google. They're currently what, 319, I guess after hours, $318 a share. Whereas deep down inside, their inherent worth, based on their own numbers, financials, and fundamentals, they should be closer to 480. Dare I even say 500 a share. So $300. That's what I mean by value investing. This is a value-oriented business. Their PE ratio is a 16, but this one is not fair. The reason why their net income is so inflated that allowed their PE to be lower is because of their equity stakes and investments in Anthropic and SpaceX. And because of that, it's artificially low. And so for a company like Google, I would rather look at next year's EPS, because next year's EPS, it doesn't have any funny money or accounting manipulation, one-time tax write-offs, or anything crazy to distort the numbers. So for their forward trading PE to be at a 24, I still think that's pretty low, especially for the numbers that they're executing. I think it's spectacular. I mean, look at the difference, right? Stellantis was up and down. It's a roller coaster ride. Okay, that's not a dividend compounder with cheese. Google, on the other hand, year after year, without fail, up and to the right in their top line. Exactly what you want to see. Another really good example would be Microsoft. They're currently, what, 381? I have their fair value estimate at 550 a share. Also, a very good prime example of value investing, especially when you take into account, actually, is this one better visuals? Yeah, this one would be, right? The blue represents their top line, the gross sales. The green line is the net income. Year after year, it just gets bigger and bigger and bigger. While at the same time, their forward PE is a 20.6. So I would rather buy a Microsoft or a Google at $300+ a share than to gobble up shares of Stellantis. Because Stellantis, that's not value investing, that's a value trap. You think it's on sale, you think you're getting a good bargain, but buying into it, I'm gonna lose money. And I know I'm going to get heat for this next one, but hear me out. Even Uber, I think they're really undervalued right now. Their forward trading multiple is a 17.8, and I get it, they have a lot of risk, especially with the autonomous vehicles ramping up and taking up market share, especially in the bigger cities like Austin, Houston, Phoenix, LA, San Francisco. It's scary when we talk about Waymo, ZooX, Tesla. Like, yes, that's a real threat. But if you take, once again, let the numbers do the talking. Okay, to give the market some credit, Up until 2023, they were a dumpster fire, burning cash in order to keep the lights on. How do I know that? Their net income, after reflecting all of the accounting overhead costs, such as how much you pay your workers, your insurance, your real estate, whatever, all of your bills, what's left over that's going into your pockets, they were negative $9 billion. But once they became profitable in 2023, just look at their net income staying relatively steady at about 9 to $8.5 billion, while at the same time, their gross sales went from $37 billion to $53 billion. And if you take a look at their free cash flow, which is how much cash is left over after accounting for the operations. So the cash flow statement, you cannot manipulate it by doing one-time tax write-offs or financial engineering. What you see is what you get, how much cash is actually left over. Just they are printing cash as of 2023, $3.3 billion to now $9.8 billion. And they're just gobbling it up, becoming more dominant in what they do, and yet the market does not care. I mean, since 2023, their gross sales, I mean, just that's a beautiful picture to see and to witness. So I would even say that Uber is undervalued, knowing full well there's risks ahead, but to have a valuation of a 17.8, I mean, right? That's when you know things have gone a little too far. And so to paraphrase John Maynard Keynes, the economist, the market can stay irrational longer than you can stay solvent. Just because a high quality compounder is attractive to you or looks good to me and should be trading higher, it does not mean that Mr. Market will agree right away. But needless to say, it took a while for them to explode in valuation, right? It took some years for Mr. Market to wake up and to realize, like, dude, Google is undervalued. And sometimes the reason why Mr. Market, it takes some time for him to realize what we see right now is because he's too distracted by the next shiny hype stock. And I don't want to ruffle up too many feathers, but there's a lot of hyped up shiny stocks in the market right now that have a lot of attention. While at the same time, high quality names are on the back burner. But with that said, eventually the businesses with solid fundamentals and growing numbers, they almost always come out on top. The key word there being growing. Don't you dare give me an anecdotal example of a company where their numbers were declining. And no, I'm talking about companies that are looking really good in the numbers, yet their stock valuation is suppressed. That's what I'm talking about. And that's exactly why, friends and family, I really like SCHD. If you are a friend of this channel, then you know I'm not shy about it. They're my most favorite dividend growth ETF, hands down. Because if you jump on over to the holdings tab and you take a look at their positions, they're not in SK Hynix. They're not in Micron or SpaceX. They're not trying to have the hottest companies or have exposure to the next momentum related plays. But rather, SCHD, they only want the high quality compounders that are executing right now, flush in cash. I mean, if you take a look at their top 10, Abbott, they're in my personal portfolio. United Health, at one point, they were 1/3 of my Roth IRA. I had thousands of dollars into them. Procter & Gamble, they're in my personal portfolio. And then outside of the top 10, we also used to be invested into Altria, Lockheed Martin, and the list goes on and on. So SCHD and I are on the same brain wavelength. And the best part is by owning SCHD or some of these other high quality compounders, value investing oriented names, the best part is they will pay you income for owning them. So not only do you get share price appreciation, but you also get passive income. Case in point, if you take a look at their number one holding of Abbott Laboratories, a 2.4% dividend yield, 6.9% dividend growth rate, and 54 years of raising their dividend, no matter what the scenario, no matter what conflicts were happening around the world, no matter who was in the presidential Oval Office, visually depicted is beautiful. And you can't tell me right now with a straight face that SCHD is trash as depicted by the blue line, when year to date, 23% in the green, that's beautiful, against the benchmarks, the QQQ, NASDAQ 100, and of course SPY, the S&P 500, 11% and 8%. Sign me up with SCHD. You love to see it. Value investing is not dead, it's alive and well. Then again, I don't want to come off as disingenuous because I'm only human too. So between you and me, I do feel the FOMO sometimes, right? Like I think maybe once a week, sometimes once every 2 weeks. Like when I see some of these names hit 50 to 100% on a single trading day, like, yes, I'm a human. Of course, I feel some emotions, but instead of throwing out my entire investing philosophy right out the window, bye bye, to chase whatever's hot this month, dude, I've just been doubling down. I just keep buying high quality compounders that are undervalued. No, my CAGR is not 50% or 70% like some people who just went gung ho into Micron and SanDisk. I'm a little bit more diversified than that. I do beat the market, but not by a wide, significant margin. But the point that I'm trying to get at is instead of chasing all the hype and momentum, I'm just staying true to what has worked for me, knowing full well that for some of you that are in Micron and SanDisk, dude, I'm rooting for you on the sideline. It's not enough just for me to do well. I also want to see everyone be crushing it as well. It's just a weird part of my personality where I think when I was younger, I did used to feel emotions of like jealousy or have selfishness about whatever my endeavors were. But the older that I get, the more I just want to see everyone else succeed as well. Like for everyone, your health, your family, your career, your relationships, like all of us to be doing well. So if you are invested in the hype related names, I'm serious when I say I hope it truly works out and you time the exit perfectly and you walk away with 100, 200, 400% gains. Me, as I alluded to earlier, I just can't do it. My risk tolerance won't allow it. And that's because deep down inside, I mean, I could be wrong when I say this, even a good business can be a very bad investment if you overpay for it. If you buy at the top, like Cisco, 25 years to break even. Then again, maybe I'm making a mistake, and that's why my CAGR is not 50 or 70%, right? So, what do you guys think? Let me know your thoughts and opinions down below, and I'll talk to you guys really soon. Stay safe. I love you. Good luck in the stock market. See ya.